The question has to be this week, what is going on with the bond market? There's some message being sent, but what is that message?
Well, at the end of the day, you have this great debate going on of a correlation when the yield curve inverts versus a causation, and is it signaling recession? And so I think the real question is, what do we think about the economy? And if you look at what our experts predict in Bank of America, Merrill Lynch, our research team with Candace Browning Platt and the team, they basically have the U.S. growing at 2.3% this year, 1.8% next year. But if you broaden out to the blue chip consensus, nobody has a negative number for 20 or 19. And so the economy is growing, but the question, the debate is the bond market signaling something? And in the probability of recession, people are raising their estimates from 20% to 30% or 30 to 40, but they're still 30% or 40%, and we see nothing in the underlying data that says it's happening today.
So you have a lot of contacts with clients across the country for Bank of America, including small, medium-sized companies, individuals. Are they starting to borrow less? Are they starting to invest less? Is their business activity giving up at all?
No, they're not. And so, in the end of the day, the U.S. economy is the largest in the world by 30%, 40%. The U.S. consumer economy is the second largest economy in the world because it is bigger than China's economy. And so when we look into that economy, we see good things right now. And it's been increasing during the course of 2019. And so what do we see? We see it based on consumer spending. When I talk about consumer spending at Bank of America, through August 12th, $1.9 trillion was spent by our consumers on debit and credit cards, checks written, bill payments made, cash out of the ATM that they spent in the economy, ACH payments, $1.9 trillion. That is up 5.9% for year-to-date through August 12th versus year-to-date through August 12th of 18. 18 was up about 8.5% over 17. So you've seen an 8.5% growth and almost 6% growth. That means that consumers spending a lot of money, and they're doing it across the board, whether it's experiences, whether it's going out to dinner, whether it's traveling. And the nice thing is they're actually getting a lift now from gas prices coming down, which actually provides a benefit to spend, and they're out spending that, which means that's going somewhere else in the economy.
You mentioned credit cards. So what about credit overall? Are you seeing delinquencies increase at all? Are you seeing any backing off of using of credit cards? Are you seeing any need to reserve more against bad debts?
Not at all. Not at all. And the credit card charge-offs have been very low and stayed that way. Despite my team once in a while saying it's got to go back up, it's got all-time lows, it's got to come off the bottom. It really hasn't. Stayed fairly constant, and that's part because we underwrite well as a company. But also, the reality is with an unemployment rate of 3.5%, with new claims for unemployment in the low 200,000, which is a nominal number that hasn't existed for 50 years, to give people a sense. Not a percent, but a nominal number that hasn't existed for 50 years. The average worker is working, getting paid more, and they're making their way through. And if you think about that, that's going to translate into good credit performance on the consumer side. And then with the mortgage rates now, you're seeing a tremendous kick up in production. We're probably seeing double what we saw last year. And year to date in July, or month to date in July, for July was up twice, August even faster. So people are taking advantage of lower rates, and that will provide a benefit to those consumers to be able to save money on their mortgage payments and either invest in their home or spend the money doing something else.
That all sounds pretty encouraging. So what happened to the bond market this week? I mean, we have the 30-year that set a new record low in yield. You have the yield curve inverting on the 2s and 10s. You have any number of indicators that would suggest there's something wrong. So what caused this?
It's largely outside the United States and largely inside the United States around the concerns around trade and manufacturing. And so if you look around the world, there hasn't been a lot of great news lately, whether it's the Brexit situation, which just doesn't seem to settle down, Europe slowing down, and the Europe Central Bank saying we need to slow down, China slowing down, the impact of the trade war across the regions, the need for companies to restructure their supply chains to avoid the tariffs, which means they're spending money to just move things, not really spending money to produce new products and new capabilities. And so that debate, and then more importantly, the debate about the debate. So the old saying, we have nothing to fear but fear itself. We have nothing to fear about a recession right now, except for the fear of recession. And that's what's really going on. You're seeing a lot of people, look ahead and say, if trade war continues, if this doesn't get solved or that doesn't get solved, you could see this finally getting to the consumer confidence, which in the U.S., which is actually the critical thing to maintain. The business confidence has come down a little bit, but still very strong, especially small businesses, medium-sized businesses. They're fine. It's just that they're a little more worried about what's going on around the world.
Can the United States keep this going by itself? I mean, you had Germany actually with negative GDP growth last quarter, and you have China, as you said, slowing down. Is it enough for the United States to keep going, or at some point does it become contagious?
You know, I think if you go back and look, you know, people say, what's this environment like? It was like 3/4 of this decade so far, if you really think about it, where the U.S. economy was recovering and growing, and yet the economies around the world were struggling. And then we had synchronized growth for about a year, if you remember, a few years back, and when Europe started growing, and people felt good about Europe as it moved above 1 to 1.5, and people were feeling good. So I think the reality is the United States can help push along because it's sheer size. The U.S. spends on healthcare what the entire Indian GDP is. So, and that's the 5th or 6th largest economy. So think about that context. So as long as the U.S. goes, it can help. It would sure help if Europe, which is a similar size economy, add all together, was growing faster. It's slowing down, but and that's the reality. So I think it's tougher sledding for the U.S. economy to carry its weight today. But and then the additional uncertainty around trade and how it's going to impact business plans and capital investment is really the concern. But the U.S. can do a lot to carry the world. It's just that it has to really be set up to really be pushing.
So what should the Fed do? There is no shortage of people giving Jay Powell advice right now, from the President of the United States on down. Why don't you join that chorus? What should he be doing given the situation as you see it in the U.S. economy?
Well, I can guarantee you one thing that Jay Powell doesn't need is one more piece of advice on this. But you know, I think he's been clear that they're thinking about this sort of in the recovery in the growth periods of the 90s when there was a need to go in and make financial conditions a bit more accommodative to help prolong this longest in history growth period. And so if you see things slow down, the uncertainty of trade, Europe slowing down, the outside United States, they dropped the rate 25 basis points with a view that they have to help the United States push forward. To your point, if the United States is going to help carry this, they've got to make sure we don't go backwards. That's the real question. And so as you look at what he's doing, that's what he's saying. He doesn't. Well, I shouldn't, in his press conference and in his statements and in the statements around, they don't see anything we don't see, which is the economy's fine and U.S. consumers fine. Everybody's worried about whether the confidence will break or whether there'll be issues. And so therefore they're trying to put what they call insurance cuts under. And so what they should do next is continue to watch the data and they'll make choices. But I think people are overreading the negative side of what they see, and that's been whipsawing back and forth. It's more that they need to help prolong and create accommodation. So this recovery can just continue. This is the longest recovery ever. So keeping it going in this size economy takes some help.
But from what you're seeing with your clients and your vision on the economy, it doesn't sound like an emergency 50 basis point cut is in the cards.
I wouldn't say that, but on the other hand, you know, I don't see what he sees. And the fact is, whatever you project for the next meeting, whatever you're looking, one of the Fed governors from a bit ago told me that everybody thinks we're on this path, but we're really climbing a mountain one handhold at a time. So we have to look at what's going on then when we make the decision. So what we don't know, you and I don't know, is what will be true when they go to the next meeting. Will there be a serious change in the trade situation? Will there be a serious change in Europe's outlook? But it's the outside United States danger zones that are causing the concern they have. When they look inside the United States, the inflation's been ticking up, wages are growing a little faster, unemployment's strong. The types of things they really pay attention to are there. And by the way, the rate structure is relatively low. I mean, we never got back to a quote normal Fed funds curve, and so by bringing it down, they can add a little help to the economy.
The part of the mountain that Mario Draghi sees and the ECB sees is a bit different from the one that Jay Powell sees in the Fed. We have a meeting coming up in September. Given what you said about the weakening of the European economy, do you expect some major stimulus coming out of the ECB?
They've said they're going to do something at various quotes, so I assume they are. And that's the real question. As I said before, what the bond market is telling you is two things. One is there's not a lot of good news coming out of the trade situation. China is going to go on a lot longer. It's not clear that there's not going to be a hard Brexit, which could be more disruptive than people thought. It's not clear Europe's slowing down because they're more exposed to China than the U.S. is. And it's not clear if some other countries are struggling. So that's what everybody sees, and that's what the bond market's telling you, on the one hand. The second thing the bond market's telling you is the flight to quality is extreme. So if you think about 96% of the yield available, our analyst said today, is available in the United States. And so at the end of the day, you have $1 to invest, and you're somewhere in the world, and you have a chance to give that $1 to somebody and get back less than that $1, or give that $1 to the U.S. government and get back that $1 plus 1.5% for 10 years. Which would you do? And that flight to quality is just huge. So the question is, it's both those factors driving that. And I think the ECB's got to get their economy back on track, and I think they've been clear that they need to do that.
What does this mean for Bank of America, Merrill Lynch, and its business? Because we've talked before, you are a basic bank that loans money and takes deposits. Interest rates really affect your business. What does this mean for your net interest margin? What does this mean for your top line and your bottom line as we continue to see rates go down?
Well, you know, I've been CEO for 10 years now, or coming up to the end of the 10th year, and for 6 of my years, the interest rate environment was like what the worst estimates are for the forward curve. You know, when people said it's going to go back to 25 basis points and Fed funds rate and stuff, that was life 10, 11, 12, 13, 14, 15, they started raising rates. So if you go back and look, a straightforward way to think about it is our net interest margin percent, so the difference between our asset yields and our liability yields is about 2.4% now, round numbers. In 15 it was 2.2%. And so the question is, we could go back to where you have the yield come down, net yield between the assets and the liabilities, largely because of the non-interest bearing accounts hit the zero floor. I mean, and that's, you start to get pretty technical here, but basically we have, $600–700 billion of non-interest bearing checking accounts, both in the commercial world, in the wealth management, and the consumer world, all three, that can't go below zero in the environment. And so that sort of puts a floor on your ability to take your liabilities down. But if you think about that, since that time, we have $75 billion more in loans, $200 billion more in deposits the last 3 years. So we have more raw material running through that percentage. And on top of that, it's like 30 times much capital return over the next 12 months as we had in the year 15. 30 times. And so we have $30 billion of buybacks coming, $7 billion plus a quarter. You have $6–7 billion of dividends coming back. Back then, I think we were buying back $5 billion of common and paying a dividend of maybe a nickel or 7.5 cents, something like that a quarter, versus 18 and buying back $7 billion a quarter. So the circumstances are much different in terms of the underlying thing, as long as we don't go in a recession, and we don't see that.
Are there offsets that also benefit you from lower rates? I mean, for example, you mentioned mortgage activity goes up because people have lower rates, they can refinance their mortgages. Do corporations restructure their balance sheet? Does that help your investment bank?
Yeah, if you look at one of the interesting things, if people really believed a recession, you'd see spreads blowing out. And so if you look at a couple things, year to date, the high yield issuance and high grade issuance are very strong, higher than last year. High yield loans are lower, but high yield bonds are higher. And the spreads have been relatively behaved. They move in and out, but they're not blowing out. If people really think things are bad, go back and think about 07, 08, when you really thought things were bad, and the high yield indexes blew out to thousands of basis points and stuff. So right now it's more of a question of what will happen as opposed to people see it. So this is very constructive for people financing, and this helps companies who are facing there's a great debate because of the very low rate structure for a long time and a lot of bonds done that were 5-year maturity. What's going to happen when they mature in a higher rate environment? Well, guess what? They're going to get a window to get out now, and you're going to see a lot of restructuring going. So that's good for activity. The M&A activity is decently strong. The mortgage securitization activity, obviously, we for other companies take their mortgages and package them, get them to market. It's okay. So I think what we see in trading, what we see in investment banking activity, Matthew Coder and Tim, the investment banking side, have done a good job, and the business is plugging along. But with the worries out there, you're seeing less capital spending, a little bit less borrowing. Our core loans are growing, but you're going to see less sort of activity if people sort of are waiting a month to do something or 6 months to do something.
You're responsible for a very big international bank, multinational bank. Geopolitics affect you necessarily. Is the China trade dispute affecting you and your business?
I think there's 4 things that would help the world a lot in terms of geopolitical. One was to get the U.S. budget deal done, because people forget that a shutdown in the context of 18 was off the euphoria around tax reform and the euphoria around a stronger growth projection. If you had that now, it would be a much different environment, and so it'd be a little bit more like the environment 11, which was very ugly when that debate. So the good news is they took that off the table for a couple of years. The second question was really the USMCA, which is we have to get a trade deal done between these 3 major trading partners to provide stability to trade around the world, and also show that countries can actually agree on trade, because right now nobody's getting deals done on trade. So that would be number 2. Number 3 is, I think we got October, we got Brexit. We got to get through Brexit without having a major blow up, and we're all nervous about that. We all worry about that. It's not clear how it's going to happen. It hasn't been clear for a couple of years, but now we're getting more to the edge. And then the fourth is the China situation. I personally believe this is the hardest one to solve, because in the end of the day, when you go around the world and talk to businesses, they believe the situation between China and the rest of the world has to be fair, freer, has to be more open access, has to, intellectual property has to be more fairly taken care of across the board. But these are very difficult issues. And I think that's why it's going to take longer. So I think if we're going to depend on China being the solution here, I think it could not get worse, and that would be fine. And I think it could bounce around a little bit, and I think it could be ebbs and flows that you're seeing just in the last week. But it's a very tough negotiation compared to the other ones, which I think they could get done and we could get through.
Have we added a fifth now in recent days, and particularly financial institutions, including Bank of America, which is Hong Kong? Is there a threat to Hong Kong as a financial center?
You know, I don't think it's outsized. I think but it's a serious situation, but it's a geopolitical situation. You know, our teams are going to work every day, and you know, we watch out for them, we monitor it consistently. They meet at 6 a.m. every morning to decide what to do. That's just not a pleasant operating structure.
Are you cutting back on your footprint?
No, we're not doing anything. And so the team's there, they're working away. It's a great group of people. And you know, our thoughts are with them because it's a tough environment, but those kinds of environments are no fun. And we've had them in different markets when different things happen. Because at the end of the day, you know, who wants to get up every morning and say, do I go to work today? Do I not go to work today? Am I going to be able to get there? That's the human being count. My belief is that situation has solved. It's a geopolitical situation. It's not a financial center risk right now.
Let's talk about something that I know is important to you. You talk about it every earnings call, and that's online banking and the progress that you've made in online banking. Where are you now? How far can you go?
Well, I think there's two things that. One on the consumer side, we'll come back to that, but one of the interesting things that we're showing people is what's happening in the wealth management side and what's happening in the commercial side. So 60% of the wealth management customers are now using the online and mobile devices, mobile applications. So you're moving that up to a cohort that people would say are they're going to be a little bit more reluctant to use it. And then on the commercial side, you know, we just brought out the ability to take your Apple Watch and make a payment on a commercial cash pro system, it's called. And so the digitization of that, you know, digital check deposits, even on the commercial side by small businesses receiving checks in from, you know, us paying them for something, you know, that's going up 200% a year. So you're seeing the digitization of what is a small portion of cash, of cash and checks happen there, and that's largely through the interfaces that you have. The ability of small businesses to, you know, send wires and checks and stuff. So there's a lot of good news there. 500,000 people using the system. The volumes are going through. Come back to the consumer side because that's what everybody talks about. We're at 38 million digital customers, 28 million mobile customers. In the second quarter of 2019, 2.4 billion customer interactions took place in our consumer business at Bank of America. 2.3 billion were digital mobile. The second part of that is it's critically important that we have great financial centers and teammates at those financial centers. 750,000 people come in every day, sometimes 1 million people, and we have to serve them extremely well, and the team does a great job doing that. So the key is not to focus only on digital or only on physical, it's to have the best of both, and that's what we're driving our team at. The impact is amazing. Our efficiency ratio on consumer business is 45% range now. The digital mortgage is now 30% of the production, and will be higher now as we see this refi boom. The sales overall in digital sales are 30%. The checks deposit are 75% through digital means. Yet still, every day, $500 million goes out in cash from the tellers and the ATM. So it's still a physical world, and we're happy for that, and we drive that too. And so it's really been an interesting case, and I think there's a lot of room to go. The statistics just sort of numb you. Zelle, you know, we had $40 billion last year, and we're already through $40-odd billion of payments this year so far. Erica, 7 million users, 50 million consumer interactions the first half of the first year in operation. You know, these are things that will play out over the next decade in terms of how they impact the company, but it's just critically important, and we've been awarded the best digital this, the best mobile that, the best digital by, you know, Forrester, Dynatrace, and all these companies, and JD Power and others, and we're proud of that, but the question is, it's all a nice start. That's what I tell the team. We got a lot of room to go here.
Brian, you've been describing a glass that is much more half full than half empty, whether it's the economy or the business community. Does Washington agree with that? I mean, are you in contact with people in Washington? Are they concerned about the economy? Is the White House, is President Trump, have you talked to President Trump about this? We talked, our teams talk to their teams all the time, but you know, everybody's concerned about the impact of these 4 or 5 issues I outlined on the economy, and can the U.S. economy sort of bowl through and carry it? The reason why the rate structure in the United States is higher than the rest of the world, because our economy is stronger.
The reason why the money's coming here, because our economy is strong. So when you think about it, one of the conundrums we have is by being the strongest country, the biggest economy, and it's growing, and it's fundamental rule of law and labor rules and all that good stuff, that is great. But in times like this, the money comes flying in, and that causes some strange things. But you're going to be affected long term by the outside, because at the end of the day, we're 330 million people. There's 7 billion out there. At the end of the day, we're the largest economy, but we add up all the rest, we're 20-odd% of it. So we will be affected by it, and there's concern, but it's mostly that concern, honestly, and that's why these sort of cross-border things have to fall in place, and whether it's trade or whether it's other things.
Well, is that the biggest risk? Because that was going to be my last question. Yeah. As you look at all of this, a lot of good that you see in the economy, in your business, what's the biggest risk?
There's one really big risk, and that's if we talk the U.S. consumer out of growing, and small business, medium-sized business out of investing. And right now they're okay. Consumer's strong, U.S. businesses. But if we have this long dialogue about how everything's going wrong, you'll have that problem. And so I'm not trying to be glass half full. Believe me, we manage a lot of risk. We have $2.4 trillion balance sheet out there every day. We are managing risk and underwriting loans and watching business plans and watching people. In the retail segment, you're seeing us have to work with companies to restructure and stuff. So it's not like we don't manage risk. But the real issue is if we talk ourselves out of, if we talk those group of broad-based economic activity into that something's wrong that they don't see, and that's the real risk out there. I mean, you have cybersecurity and all the other stuff and terrorism, all this stuff. But the real risk for the U.S. economy is if the consumers slow down. And right now, the good news is, even though it hasn't gotten better during 19 in terms of the news of the day, they've actually increased their activity. And so we'll see what happens.